Good afternoon. This is Cesar Farfan, the Head of Retail Distribution for Perennial Value. And next to me is my colleague Stephen Bruce, the Portfolio Manager for the Perennial Value Shares for Income Trust. Welcome to our live webinar for the eInvest Income Generator Fund. I might just, you should be able to see a presentation on your screen. Just a bit of housekeeping. You're all muted, so we can't hear you, but if you do have any questions, you'll find on the right-hand side of your screen, there's a navigation panel. There's a little orange arrow or button up towards the top. You can open and close that panel and you can type in questions. So feel free to ask any questions or type any questions into that panel throughout the presentation, and we'll make sure that we allow some time towards the end to answer those questions. Just moving on to the next slide, just a mandatory disclaimer or important information. Sorry about that. I'm just going to provide a brief overview, touch on some of the benefits of the eInvest Income Generator Fund, and talk a little bit about the structure before passing on to my colleague Stephen, who's the Portfolio Manager for the fund, who'll then go into a lot more detail about the actual capability, strategy, and also talk about some case studies and stocks that we invest in. So in terms of eInvest, basically it's a listed version of the Perennial Value Shares for Income Trust, which we've been managing for over 12 years. This trust was designed to provide a regular, reliable income stream to investors in the form of dividends, but also has outperformed the market on a total return basis since inception. It's never failed to pay a distribution, and has a very solid track record, as I mentioned. And Steve will touch on the capability in more detail. Unlike the current fund, which is an unlisted trust, we've actually set up eInvest to be delivered via an efficient, cost-effective, exchange-traded managed fund structure. Basically, what that means is it's a listed fund. So unlike an unlisted fund where you've got to generally download a product disclosure statement, get the application form, answer lots of questions and fill out reams of paperwork, to buy units in this fund once it lists or through the IPO process now, you basically, it's a click of a button. So once it's trading, it's like buying or selling any other share. There are many exchange-traded funds on the Australian Stock Exchange. Most of them are passive. So what do I mean by that is, or they actually track an underlying index. There are also actively managed exchange-traded funds like ours, and that's exactly what we're bringing to market. So it's got some of the features and benefits of a passively managed exchange-traded fund, but also the benefits of having an active approach, professionally managed by a fund manager like Perennial. It's a fairly straightforward strategy. So you'll notice that on the stock exchange there are many funds. Some aren't that straightforward. In our case, we're a value style manager. We're a bottom up stock picker. We basically do all the hard work that's involved in identifying good companies that have strong balance sheets and are paying dividends out of true cash flows. And that's very important, because part of, I guess, managing an active fund like this is not just picking the good stock, but avoiding the bad ones. The fund's also not reliant on any complex derivative strategies or gearing. And the last point I'd like to make here in overview is that obviously we're seeing synchronized global growth, particularly led by the US, and what that means is that we're seeing interest rates move up. Some companies that have lots of debt on their balance sheet could be adversely affected by rising interest rates. We tend to call those interest rate sensitive stocks or bond proxy stocks. They're stocks like some of the infrastructure companies like Transurban that own toll roads, etc. So we're actually have a very small exposure to those types of stocks, which means we think our portfolio is well positioned in this rising interest rate environment. Just moving on to the next slide in terms of the key benefits. Basically, eInvest Income Generator was set up to provide a reliable, regular, tax-effective income stream paid monthly into your bank accounts. That distribution is made up of a 5% cash yield and a 2% franking credit. So obviously to get the benefits of the franking credits, you'd have to be invested over a 12-month period or 1 year. And we know we can deliver this because underlying trust has exceeded this. And Stephen will talk about the track record of the underlying trust. More importantly, it's paid by a monthly distribution straight into your bank account. In addition to having a focus on income, there's also there are long-term capital growth benefits that are associated with this strategy. Shares tend to go up more than what they go down, so that we also know because we've been managing the underlying strategy that we've also generated capital growth over the long term. It's well diversified. Once again, Stephen will talk a little bit about the number of stocks that we own and the portfolio construction process. But very important to note that this is an active style. This is not a passive approach. It's not tracking any index. And we're delivering it to you in an efficient, low-cost listed structure. It's basically a listed fund that it'll look and trade and feel like a share. Look, ideally suited for any investor that's seeking income. More so, though, we think for retirees that are in pension phase and obviously no longer growing assets or generating income outside of retirement. I'll just touch briefly on the structure. Once again, just to keep it really straightforward, it's basically a listed managed fund. There's lots of them on the market. We're seeing more and more fund managers bring these types of products to the market, I guess, to meet the growing demands of their investment base who are seeking ease of access to these opportunities, particularly through self-managed super funds. Some of you might be familiar with listed investment companies. They are a share. They don't always trade or reflect the value of the underlying stocks they hold, so they can trade at a slight discount or a premium. And that's not ideal, in that if you're an investor and your shares trading at less than what the underlying assets are worth, it's not ideal, and that you'd probably like them to reflect the true value. But equally, if you become interested in a particular listed investment company that's trading at a premium to what the underlying holdings are worth, then you're probably a little bit reluctant to buy in. So it's not the end of the world, but it's not ideal. Now that won't happen with this structure. So this is a listed fund. It's a trust. We've appointed Macquarie as a market maker, and basically what they do is they ensure that the units always trade at or very close to the net asset value of the underlying holdings, which means you're not going to have this situation where you're trading at a discount or a premium. I guess also one of the features of exchange-traded funds is the transparency. So you can see at any point in time with most passive exchange-traded funds what the underlying holdings are. In our case, we're going to show your portfolio holdings every month. So you'll be able to exactly know what stocks we own. There'll also be no setup costs, so Perennial Value will be meeting all the upfront establishment costs. So basically, if you invest $10,000 to buy units for this product, when it lists, they'll be worth $10,000. All else being equal, obviously, with not taking into consideration market movements. So all the upfront costs will be borne by us, not by the trust. We're going to offer this capability at a very competitive rate of 0.65 plus 0.15 which are the costs of the trust, but that'll be capped. So all up, you're paying 0.8. Now, if you compare that to some passive ETFs in the market, we're probably not that much more expensive than some of them, but you're getting the benefits of an active fund manager with a track record managing your money. So on that note, I'll pass on to Stephen Bruce.
So good afternoon, ladies and gentlemen, and thanks very much for your interest today. So, right, this product really is all about generating a superior income stream. We know investors are after an income, but look, in the current market, it's pretty hard to find it. We've set out some of the options here. You can put your money into a term deposit, earn 2.3%, barely cover inflation. You can buy yourself a government bond, hardly earns you any more income than a term deposit, and you know you're going to lose money when interest rates go up and bond prices fall. Bank hybrids, they've been very popular. That 5% or thereabouts yield, that's starting to look a bit better. But one of the things about hybrids is they're a bit like stocks. You know the day that there's a problem with one of the banks, CBA, Westpac, its hybrids are going to start performing like shares. They're going to go down. So that leads us to the equities market and a portfolio of high-yielding shares like we've put together that can deliver you pretty reliably a pre-tax income yield of around 7%, which is what we're targeting in this product. So a much more attractive level of income than many of the other options around. But of course, it's not really just about income, how high the level of current income is today. What's really important is how that income stream grows over time. Now, fixed income things, term deposits, bonds, hybrids, etc., their income stream doesn't grow. But if you look at a good quality share, as its earnings grow over time, its earnings per share grows and its dividend per share grows. So that growing earnings stream that a good quality share can give you is really important in giving you an income stream which grows and offsets inflation to maintain your purchasing power. And then, of course, there's a capital growth aspect. A fixed income investment, obviously, your capital never grows, but we all know that over the long run, shares grow in capital. There are ups and downs in the market, but there are a lot more ups and downs. So not only is there a higher level of current income from shares, but it's an income stream which grows and capital which will grow for you over time. On top of that, our structure gives you these regular monthly income payments, and we think that that's something that's very the investors will like, that reliable, predictable nature of the income. And then the exchange-traded fund structure, it's liquid and it's convenient. You're just quick to buy, quick to sell, and it always trades at net asset value, i.e. the price of the underlying assets. Never trading at a discount, never trading at a premium, so you can always get in and out when you want at the right price. So a little bit about our firm. Some of you may be familiar with our firm, some not. We've been around for 18 years. We're founded by a chap named John Murray, who's a bit of a veteran of the industry. I myself have been with the fund since the first day as well. We're a fairly substantial firm with over $5 billion under management across multiple Australian equity strategies. And because we're big, we're well resourced. We've got all that strong legal and compliance and back office work. It's all done internally. And we're a boutique, so we're majority employee owned. And what that means is you get pretty low staff turnover, and that's important in an investment manager. So 15 investment professionals in the team with over 200 years of experience between us. All fund managers do things differently, but at the core of the way we do things, it really comes down to this detailed financial modelling, and we run models on over 200 stocks at any given time, and that's the bread and butter work of the analysts day in, day out to really understand what we're investing in. And importantly, we've got a long-term track record. We've been managing money for 18 years, and we've been managing our income-oriented portfolio for 12 years since 2005. So we've seen a lot of different conditions in the market over that period. Just touching on our team a little further, you can see John Murray, the founder, on the left. That's myself in the middle, and I'm the portfolio manager in charge of this strategy. On the right is Damien Cottier. He's the deputy portfolio manager for this strategy, and he also oversees the research effort in the team. You can see our team members, the rest of the team members listed below, and collectively there's a lot of experience there and a lot of tenure with the firm. So talking about our investment process, really what we are, we're a bottom-up, fundamental-driven, value-style stock picker here, and quite simply that means we're looking for quality businesses where we reckon the earnings and dividends can grow over time. So we're looking for businesses with a track record of profitability, and being a value-style manager, valuation is very important in our portfolios. We make sure they're always trading at a discount to the overall market when you measure them on the metrics we look at, such as price to earnings, price to cash flow, price to book, etc. And the one thing that we really pay a lot of attention to is balance sheets. Minimum net interest cover of 3 times, because everything rests upon a balance sheet, and especially the ability to pay dividends. So the sort of stocks we're buying for this portfolio are the same sort of stocks that we buy for our main flagship Australian Shares Fund, but the difference is in this portfolio, where the emphasis is on delivering a higher level of income, when we're constructing the portfolio out of that pool of stocks that we like the valuation and fundamentals of, we put it together by tilting towards the high yielding stocks. For example, we don't have anything with a yield less than 4% in. We'll move the portfolio around a little bit around dividend paying periods to capture more dividends, and we'll participate in off-market buybacks, which are a very good way of collecting franking credits as well. Looking a little deeper at the investment process, as I said, it's fundamentally driven. It's not quant-based. It's not just chasing yield around the market. It's buying stocks that we like the underlying fundamentals of. Underpinning that is deep financial analysis with an emphasis on balance sheet strength. And then there's what we call a focus on true cash yields. And that means not getting tangled up in anything where there's financial engineering, because history's shown that ends really badly. And our process, as I said, we've got a 12-year track record, so it's been through the good, the bad and the ugly through the cycles. So in many ways, I think our fund is quite different to lots of the other income funds on the market at the moment. When it comes to how we put the portfolio together, the portfolio construction and risk limits, this is all very, very straightforward here. It's a moderately concentrated portfolio, 30 to 40 stocks, with a minimum market cap of down to 500 million, which allows us to go down into the mid caps when there's opportunities. We have a maximum cash of 20%, but we're always basically fully invested, which means cash of less than 5. In our stock and sector weightings, we deviate plus or minus 5% at the stock level, or plus or minus 20% at the sector level from index. And we're typically represented across 7 or 8 of the sectors in the market. And we have a real emphasis on diversification because we want to spread our risk around. And in keeping with the theme of keeping this product really simple, we don't have any gearing and no significant use of derivatives. We want this to be a low risk, predictable, understandable product. So what does that mean in real life? When we think about how our process and philosophy has led us to invest in the past, it's a good example is to cast your mind back to 2007 and the eve of the GFC. If you can remember back then, the REIT sector, that was the go-to place for retail investors looking for safe, reliable, sleep at night income, and it had been that for a long time. But by 2007, if you had a look under the hood, these things have been loaded up with debt, were paying their distributions out of debt, not sustainable, had made all sorts of bad acquisitions, and in our view, were just a time bomb waiting to go off. And as a consequence of that investment discipline, we were quite pleased to be able to say that we weren't in the REIT sector at all in 2007. And what that meant was when that sector got decimated, when the credit market seized up, we'd say we protected our investors' capital there. And it's really interesting to see the blue line's the market, and you can see the market fell, but then recovered, whereas look how much the REIT sector fell and hasn't been able to recover. And that's what happens when you have a bad balance sheet and things go wrong. So where are we a bit worried about the market now? Well, pleasingly, we don't see anything in the market that looks like the REIT sector did back in 2007. But where we think there's a bit of risk is what you call the bond proxies. And that's really those parts of the market that have been very popular in recent years, where investors who've been looking for a bit of high yield, maybe come out of term deposits and fixed interests, have looked at stocks like the infrastructure stocks and said, oh, these look pretty safe, these look pretty reliable. I'm thinking Transurban, Sydney Airport. Now, they're great businesses, but the thing about these stocks is they've got a lot of debt and they're very leveraged to what's going on with interest rates. And we got a bit of a taste back in 2016 when bond yields started first stepping up. You know, they went from 2% to 2.8%, and that saw all these sorts of stocks sold off by more than 20%. And I think that's just a little bit of a taste of what can happen now that the rate cycle started to turn. And we don't hold these sort of stocks in our portfolio. By contrast, some of the stocks that we held, we've shown on the right-hand side, a more broadly diversified portfolio of industrial, financial and resources stocks. And you can see in this environment, these sort of stocks start to perform much better. So in that environment, our funds outperform the market. Taking it a little bit further, again, we've broken down our fund here on the right into those sectors of the market that are sensitive to interest rates, and things like infrastructure and utilities, the telco sector, consumer staples and REITs. And you can see when you add them up in our portfolio, there's only about 7% of our portfolio is exposed to that. So we don't really have much risk from this rising interest rate environment that we've started moving into. Whereas when we look at what we call in the typical income model, now this is the actual income model that one of the big retail broking firms uses for its clients. They've got more than 40% of their portfolio exposed to this theme. See that huge big red bar? That's all infrastructure stocks in their portfolio, which can potentially perform very poorly in a rising bond rate environment. And we also think that not just it is a model used in broking firms, we think a lot of direct investors are quite heavily exposed to this theme as well. So by putting some money into our fund, you can very easily, with one trade almost, really de-risk your exposure to this theme in the market and add around 30 odd complementary stocks to your portfolio, which can give you a much lower risk but also the same or better level of income. So we talked about what we haven't held and what we don't like. What are we actually looking for? Now, if we had to pick a stock that would be the pin-up child of the sort of stock that we're looking for, we'll point to one called Event Hospitality. Now, you might know that name. It's a stock that flies under the radar, even though it's a $2 billion company, but you'll recognise the brands it owns. Things like Event Cinema, Ridges Hotels, QT Hotels, runs Threadbow. It's a very conservatively managed company with strong balance sheet that pretty much delivers for investors year in, year out. Gross dividend yield of 5%, conservative payout ratio of 65%, and all sitting on top of a very strong balance sheet with only low gearing of 17%, strong interest cover of 17 times. And when our analysts look at the individual components of the business, we think there's about a 33% upside to fair valuation. So these are just an example of the sort of company we like having in the portfolio. And what about the income results you can get out of this company? We've done a little analysis here where we've simply said, if you put $10,000 into Event Hospitality and $10,000 into term deposits a decade ago, how much income would you have made in each year? And what you can see is, well, term deposits are, their income stream's fallen over that time. The income stream, the dividends from the event shares, that's just grown in a very nice steady line over the last decade with a few special dividends thrown in, and it really highlights that growing income stream, which is the real power behind investing in equities to get income. And if we take the analysis just a little further and put some numbers around it, using that same example of $10,000 in event shares or $10,000 in cash in term deposits, you can see at the top, over a decade, a $10,000 investment in TDs has given you about $4,500 of income. Of course, you've had no capital growth, so you end up with $14,500 at the end. By contrast, your Event Hospitality's generated nearly $10,000 in pre-tax income, more than doubled its share price, and give you a total return of over $30,000. Big difference. But what's really quite interesting is an interesting way to look at it, if we're thinking just about the income perspective, is if we look at the last column here, and what we're showing there is when we look at the income stream received in the last 12 months, most recent 12 months, on that initial $10,000 investment all those years ago, you've only made 2.5% from term deposits. So that's not pretty hopeless. Whereas in your event shares have generated a 12% income yield on that original investment. You know, it's a dramatic difference. So in terms of what we hold in the portfolio, we mentioned the importance of diversification, having exposure to a broad range of themes and drivers. Here's just a sample of some of the stocks that we hold. Now, I won't pick any of them out in particular, other than BHP, and this is potentially another differentiator between our fund and some of the other equity income funds out there, in that we hold resources at the moment. Now, for a lot of the life of the fund, we didn't hold any because resources weren't doing much in the way of paying dividends, whereas today the resource stocks, the large resource stocks, are in this capital returning phase where their cash flow is strong, their balance sheets are gearing, they're lifting their dividends. You saw BHP lifted its dividend 38% at the last result. Rio lifted it 70%. Rio's already done an off-market buyback, returned lots of franking credits, and BHP could well do a very large one if it sells its shale business. So we think resource stocks are a good income and capital growth generating opportunity at the moment. In terms of the track record, we've been running this for 12 years through all parts of the cycle. The objective of the underlying trust has been to deliver an income return, including franking credits, higher than that of the market. And so you can see what we've delivered is 8% per annum pre-tax yield since inception. compared to 6.1% for the market, so nearly an extra 2% of income return. And the other thing we've always tried to do is to deliver total return outperformance above that of the market. And you can see there's been some modest total return outperformance after fees as well. In terms of our research house ratings, the underlying trust is recommended by both Lonsec and Zenith. This listed version is recommended by Lonsec and recommended plus by IRR. Now, Lonsec don't do ratings on listed structures. Zenith don't do ratings on listed structures, so we weren't able to apply for one there, but we do have the rating on the unlisted version. So in summary, we know investors are looking for yield. We think this product can deliver a growing tax-effective income stream. We think that regular, reliable monthly income payment is something that investors will appreciate. And it's all sitting on top of a portfolio of high-quality Australian shares underpinned by an investment process that focuses on true cash yields. And the ETMF structure we're making this available in, it's efficient, it's low cost and it's convenient, and it solves a lot of the problems that you find around LICs, and it's more convenient than unlisted trust. So we think in summary this could be the ideal component of an income generating portfolio. So thank you, and I'll pass you back to Caesar.
Thank you very much, Steve. Just to wrap up, I'll So basically, there are three ways to access this opportunity. One is through a broker offer. So if you've got a stockbroker or an online trading account, you can access it that way. We have over half a dozen brokers that are working with us for this initial offer, the likes of Morgan Stanley, Ord Minnett, Baillieu, Bells, and others. But basically, the broker offer is available to any broker. The other way you can access the offer is through the general offer. All you need to do is go onto the Perennial website, click on the drop-down menu and access the eInvest section, and you'll be able to download the product disclosure statement, and you'll be able to apply online. It's a very straightforward process. Obviously, for those of you that do miss out before the offer closes, which is the 27th of April, you can always buy it on the secondary market once it lists. So it'll hit the ASX on the 7th of May, and it'll trade like, just as I mentioned before, like any share. So on that note, we might open up to some questions. I have a question here from the audience. So the question is, so I know there are many passive exchange-traded funds on the market, the likes of Beta Shares and State Street and BlackRock. Why would I access an active ETF like yours? Stephen?
Thank you for the question. I think it's very important when you're investing with a focus on income to really have done the fundamental work on this company you're buying. You never buy a company just because it's got a high dividend yield. And I think there is a risk with some of these passive style income funds that they're simply being constructed to invest in the highest yielding stocks in the market, for example. And experience shows that the outcomes that you get with that sort of strategy often in the long run are not very good. For example, just because a company has a high dividend yield doesn't mean it has good long-term prospects. So you really need to balance, and this is where investment research comes in. You really need to balance the dividend yield you're getting with the longer-term prospects for the stock. Also, some of the more structured products out there on the market follow these strategies such as dividend harvesting, where they're just moving really aggressively around the market, just buying stocks before they pay their dividends, then selling them, and then buying the next one. Now, that might work sometimes, but again, I think more often than not, the performance is pretty bad overall.
Thank you, Stephen. On that note, we might wrap up. So thank you very much. This is a great opportunity to access a strategy with a proven track record over 12 years. You can now access it in a listed format. The presentation will be sent to you via an email, as will the recording of this live webinar. Feel free to share that with friends and family. And if you have any questions, you know where to reach us. Thank you very much once again, and have a great day. Bye.